If you're thinking about taking out a mortgage jointly with your fiance, your spouse, your partner, whatever that is, could be a good idea. But what do you need to know about that process? Credit scores, incomes, they're all going to be different. So, how does it all factor into getting approved? We'll talk about that next with Bill Linton. Welcome into the Smart Mortgage Show. Glad to have you on the channel. Please subscribe if you haven't done so yet. We appreciate your support of the channel. Bill, we've talked, I think, a little bit in the past about applying jointly. I don't know if we've ever really dug into it a whole lot, but I want to talk about that a little bit today because, I guess anybody, if you're married, I think a lot of people just assume, okay, we get it together, but that's not always the case, right? I know personally, for me, our mortgage was under my wife's name because of a lot of different factors we're going to talk through today.
Yeah, I think that it's, you make the assumption that husband and wife are going to apply together, but for one reason or another, it doesn't always happen that way. And sometimes there's advantages to only having one of the two people on the mortgage application. And maybe we don't use a joint application. And there's other reasons why absolutely doing it jointly makes more sense.
Yeah. So I think a lot of people don't realize that when they're going into the process with their significant other. They just kind of assume, hey, we're in this together. But there might, as Bill said, be advantages. We'll talk about some of those coming up. Again, if you haven't joined us, smartmortgageshow.com. There's a lot of great information on there, all of our previous videos, podcasts, some guides as well that can help you out if you're new to this home buying process. And we're glad you're here. So the scenario here, Bill, is you're thinking about, right, getting a loan, mortgage jointly with your significant other. What are some of the factors? Because I just think through this, right? I mean, we're all different people. So I'm assuming there's always many cases where one side of the relationship is great with money. The other side, maybe not. Maybe they had some credit issues in the past. So just kind of take me through credit, income, those pillars where when they're different for each spouse, how is that weighed in that joint application?
Yeah. And I think, Ben, you hit on it already with credit. So usually that's the big one, right? If let's just say, for instance, that the husband has a credit score of 800, and in this scenario, the wife has a credit score of 620.
Okay.
So the lender is always going to use each person, like you and I, we have 3 credit scores. Lenders throw out the high and the low and use the middle score. So husband and wife, they each have 3 scores. The husband's mid score that we use is an 800. The wife is 620. Lenders base the rates and the terms on the low mid score. So of each middle score, they're going to use the lower of the two. So in this case, 620 is going to determine the interest rate and the fee structure. And there's a big difference between 800 and 620 when it comes to rates and costs.
Yeah, that's pretty significant. And I think most people might ask, well, why, Bill? Why don't you take the higher credit score here? Right, we're in this relationship together. We're a partnership. Why did you not factor in the higher score? Yeah,
well, so Fannie Mae, Freddie Mac, FHA, the VA, USDA, all the main outlets, they take the low mid score. It's always been that way, and I think that it's kind of like, it's worst case scenarioing everything, right? So they want to hedge their bets and they want to be careful, and they're going to, write it to the lowest common denominator. There are loans actually, though, where they're going to use the credit score of the primary income earner. So if in that case the husband made more money, they would actually use his mid score. Okay. But those loans aren't your standard loans. 95% of all lending is going to be based on the low mid score.
Okay. Well, what about income then, Bill? Because you just mentioned that, if you are looking at income, and there obviously going to be disparities in income, does it all get factored in together that same way, or are they looking at one income versus the other?
Well, let's go back just to the credit score and see how that relates to income, because Ben, we've had a lot of scenarios where we find out that one score is lower than the other, but maybe that 620 credit score person, maybe they don't have much income. And the person, thankfully and luckily with the 800 score, has enough income to make them qualify. That's a scenario where we would not want to apply jointly. We would remove the low income, low credit score person and then get the better rate using the income of the primary earner and the higher credit score. Now, just looking at income by itself, which is your second question, sometimes if let's just say there's a scenario where we have husband and wife. In this case, wife is the primary income earner. Wife, they both have the same credit scores, but the wife has, a really great income, really great job, really great career, and the husband, he's making very little, and the husband has a lot of debt attached to his name. So now the husband's bringing very little to the table. In fact, way more debt than income. That'd be another scenario where we might say, let's not do a joint application. Let's let the wife carry it. She's got little debt. She's got great income. She's got great credit. In that case, we're probably not going to go with a joint credit application.
Okay. What about debt then too? Is it treated the same way? Everybody. I mean, again, this is one that could be where you both have car debt, or it could be one person hasn't really taken on a whole lot of loans. So how do you factor that in, Bill? And I just think of the case where maybe one spouse has a outstanding car loan, right? That maybe has $10,000 or $15,000 on it versus someone else that maybe just has $1,000 on a credit card somewhere.
Well, with debt, it usually goes back again to if you might have a lot of debt, but if you have an exceptional income, it doesn't matter. It's when you have a lot of debt and you're not bringing much income to the table. That's when you might say, we might want to remove that person. Or, do they have a lot of debts and the credit cards are all maxed out and now that's affecting the credit? In that case, debt was the root cause that got them to say, us to recommend maybe we remove them. And, one of the other things I'll mention is what we always encourage is people will ask a lot of questions. Do you think we should do it jointly? Do you think we should do it individually? We always want to look at all of the information because we can always subtract. If there's any reason why doing a joint credit application, if there's a negative detractor to that, then we can remove that person to optimize, rates and terms based on just doing it in an individual's name rather than jointly.
Okay. So just to kind of summarize, Bill, and just kind of wrap up, what would be the situation, just kind of the common scenarios where you would go with a joint application versus the individual? I mean, I kind of got an idea of, right, if one person has a completely different financial resume, I guess, so to speak, than the other, then it might make sense to go individual. But when would it make sense to go joint, and kind of what general situation?
It would make sense to go joint if having both people on the loan didn't create any negative attributes or didn't cause any deficiencies, higher rates, more restrictions. So if it's all the same, whether there's husband on, wife on, or both on, then usually most couples will do it jointly. And I would say that's what we find more than anything with a married couple is a joint credit application. But if there's major detractors, that's when we would remove somebody from the application.
Okay. So if anyone just kind of going through this process and now just kind of beginning to look at homes and looking at the mortgage process of pre-approval, this is something you're going to help kind of walk them through, right? If they come in and they say, hey, we're looking to buy a home, we're looking for our best options, you're going to look probably at the joint option, also individual. After you see their full picture, you can help make that decision with them, right?
Yeah, and again, we're going to say, let us have all of the information. We're going to review everything and come up with the best solution. But yes, we are absolutely making recommendations all the time to remove one of the two parties just in case there's a benefit. And then sometimes we show it both ways. Hey, this is, a lot of times it's like, one of the husband or the wife is just not comfortable not being on the mortgage, and they're like, I want to be on, I don't care if it costs more. And sometimes we show them the difference in the cost, and that might change their mind, or it might make them say, yeah, for $50 a month I'm just going to stay on, but for $300 a month maybe I'm going to come off.
Very interesting. All right. Well, very good. That kind of explains a lot of the process, and hopefully gives you some things to think about too if you're going into this with a spouse or partner and kind of thinking through what's your best option. Know that there are a team behind Cross Country Mortgage that will help you through this and make sure that you are making the best decision for you and your family. Again, you can begin that process by texting the word LEND to 21,000 to take advantage of that free mortgage and loan consultation, where you'll begin kind of letting Bill know what your full financial picture is, what your goals are, so that you can begin kind of figuring out what options are best for you. If you haven't subscribed to the show, please do that as well. Hit us if you're not on YouTube. Come on over, watch us on camera versus just listening to us. But wherever you find the Smart Mortgage Show, we appreciate you taking part, and we'll talk to you again next week.
Thank you so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.